Welcome to the Bigger Cash Flow podcast, where we interview business owners and real estate investors that share tips and tricks on how to grow your cash flow and reach financial freedom.
What's up, everyone? Welcome to another episode of the Bigger Cash Flow podcast. My name is Bo Kim, your host, and today I'm very excited to share with you a tax professional that has also been in the real estate investing space himself. I've been looking forward to this interview all week, and his name is Logan Allec. He's based in Los Angeles, and Logan is a CPA, a real estate investor, and also owner of a personal finance blog, Money Done Right. After spending nearly 10 years as a tax advisor helping big businesses save money, he launched Money Done Right in 2017 with a mission to help people learn how to make extra money and grow their passive income streams. Welcome to the show, Logan.
Hey, Bo. It's great to be here.
Yeah. So let's just dive right in and kind of get your background. Can you share with our listeners what is your experience in the tax world and real estate investing?
Okay, so like you mentioned, I am a CPA here in the Los Angeles area. For most of my career, I was working at various accounting firms, working closely with real estate investors, both large and small, to help them figure out how to save the most money on their taxes. In terms of real estate investing for myself, I have done a few deals here and there, some buy and hold stuff here in Southern California, as well as investing in various syndications and things like that. So that's my background. I do really like real estate, not just investing in it, but also figuring out how people can save the most money with their investments and make sure they're doing things right from a tax perspective.
Awesome. That's probably music to our listeners' ears because, when they first start in real estate investing, they hear all about the different benefits, not just the cash flow, but the tax benefits. So let's dive in just a little bit more into that. Can you give us a 10,000-foot overview in terms of what are some benefits real estate investors might enjoy?
Well, the great thing about real estate is that you can have a significant amount of cash flow in a property and not pay any taxes on it in that year. Because, real estate, there's these cashless expenses, so to speak, depreciation and amortization and things like that you don't get, or at least you don't get to that degree in very many other businesses. If you have a bakery or something like that, and you're just renting out space in a strip mall or something, and you turn this profit. Let's say you make $50,000 in your bakery for the year net. There might be some differences between the income that you on your books and records and the income you put on your tax return, but you're probably not going to have a lot of these cashless expenses that real estate investors can enjoy. So I think one of the primary benefit of investing in real estate from a tax perspective is that you can be really cash flowing a lot, on a property or a set of properties, but be showing on your tax return that you have a loss because there's these cashless expenses, cashless deductions, so to speak.
Awesome. So you mentioned depreciation, and I think that's one of the more bigger tax expense that we get to enjoy. What is depreciation? How is it calculated? And what are some things that investors should ask their CPA about?
Okay. Yeah. So depreciation is basically a deduction you get on your property that you purchase, where you get to deduct a portion of what you paid for that property. Well, you got to split it between land and building, but you can deduct a large amount of what you paid for that property over a certain period of time. So, for example, let's just use a very simple example. Let's say you buy a house for $100,000, and let's say you determine that 60% of that purchase is attributable to the building and 40% is attributable to the land. So, that $60,000 that you attribute to the building, you can deduct, and I'll just do the math here, you can deduct that amount over 27 and a half years. So that sounds like a long time, but that's actually an extra $2,000, $2,200 deduction per year. So you're basically able to write off this asset that you purchased, which is kind of interesting, right? Because the asset is theoretically going to increase in value over time, but you get to take expenses on it. You get to take this deduction against that property that is itself increasing in value over time, which is interesting, because usually when you have an expense or deduction on your tax return, it's because you've had to spend money. You had some kind of economic outlay, right? But that's different with real estate, because this asset that you have, it's actually increasing in value over time. It's your economics are doing better, but even so, you still get to take a deduction for what you paid for that asset over the years. And there are various tricks you can do with depreciation. May not make a whole lot of sense, which is, maybe one single family home, but, if you buy larger properties, you can do things like cost segregation studies where you can accelerate that depreciation into the first year, and you can do some fun planning stuff.
Yeah, and I enjoyed watching your webinar on changes to the tax law in 2017. And one of the things that you mentioned is that as real estate investors, you want to try and keep as much money in your pocket this year because of the time value of money. So the thought is that if you're able to take a deduction and expense things in the current year and pay less in taxes, you're essentially keeping more money in your pocket and investing it for a better return. So by the time that you have to pay your taxes through depreciation recapture, essentially you would have had time to make some more money on the spread. Are there any downsides and pitfalls of using this depreciation expense allowable by the IRS?
I wouldn't necessarily say they're downfalls or pitfalls, but the IRS does, when you sell a property, you do have to, like you mentioned, there is this concept of depreciation recapture, where when you sell a property, any of the gain that's attributable to the depreciation you took on the property, you have to pay tax on that portion of the gain in excess of the standard capital gains tax rates. But there's a little bit of arbitrage here, because theoretically, when you were taking these depreciation deductions, you were taking them against your ordinary income, which for most people is at a higher tax rate or a higher tax bracket system than the recapture tax rates. So, and then there's a time value of money, which you mentioned, right? So you're getting these deductions over 10 years or whatever, which freed up more cash for you to invest in other investments, but you don't have to pay this, quote unquote, recapture tax until 10 years down the line. So, you have this benefit, this tax benefit for many, many years, and then, but you don't actually have to, flip it and go the other way until 10 years down the line. So you had 10 years of that accelerated, deductions you can take to free up cash to go invest in other things. Something else to keep in mind is that, not every expense or not every even, not all the work you do on your property has to necessarily be depreciated. Some things you can just deduct as a repair expense. And, the great thing about repair expenses is, there's not this recapture for repair expenses like there is for depreciation. So, a good CPA or other kind of tax professional can help you determine whether or not an expense you make to work on the property, whether you have to capitalize and depreciate it, which is a fine answer, or even better answer, if you can just deduct it this year as a repair. So, there's some strategy there too. And back in 2014, the IRS put forth these hundreds of pages of regulations called the tangible property regulations that govern just that question. Is a certain expenditure that's made like on a building, and should this be is this classified as a repair or something that has to be capitalized and depreciated? So there's some interesting rules there, and if you have worked with a good tax professional, they can help you maximize your your benefit.
Okay. Does that mean that if I put on a new roof, I can't just bonus depreciate it? It still has to follow that IRS guideline of whether to capitalize it or expense it?
Yeah, so roofs are interesting because there's two tax rules that are similar but not quite the same. One is bonus depreciation, one is Section 179 expensing. So if you're putting a roof on a commercial property, you might be able to expense the whole thing under Section 179. But I know, yourself and myself and probably most of your listeners are in probably the residential space. So 179 doesn't apply to roofs on residential real estate property. So, the only two options for that it's either a repair, or it's something you have to capitalize. And if you do have to capitalize it, you have to ask, well, can you take bonus on it, or do you have to depreciate it over 27 and a half years? So let's start with that first possibility, that this replacing a roof is a repair. Now, there is a position in the tangible property regulations that if you're just replacing like the upper layer of the roof, or let's say just it's a shingle roof, you're just replacing the shingles. Some of the regulations would imply that in that case, many people still call that replacing the roof, but in that case, you can take that as a repair deduction. But if you're replacing the entire roof, all the layers, and not just the shingles, but all the layers of the roof, that seems like something, but of course you had to want to check with your tax professional. It seems like something where you'd have to capitalize it to the basis of the building. Now, the question is, well, is it eligible for bonus depreciation? Well, bonus depreciation, you can only take bonus depreciation on certain assets that have a useful life under the tax code of 20 years or less. Because this roof, if it doesn't count as a repair and has to be capitalized, because this roof is being added to the basis of the building, which is depreciated over 27 and a half years, it wouldn't be eligible for bonus depreciation. So your best bet would be to see if there's a position you can take to call that roof replacement a repair. And that's something you'd want to talk to a tax pro about and have he or she analyze it through the lens of those tangible property regulations.
Awesome. Thanks for clearing that up. And last but not least, on the topic of depreciation, I often hear investors tell me, hey, Bo, I decided I'm not going to take depreciation expense this year because my CPA told me that there is a depreciation recapture once I decide to sell the property. What do you say to investors thinking that they can elect to take it or not?
When you sell the property, whether or not you actually took a tax benefit, whether or not you actually reported that depreciation over the years on your tax return, the IRS is still going to reckon your gain as if you did. Simple example, and the math's not going to tie out on this, but let's go back to the example of the building or the property you bought for $100,000. You attributed $60,000 worth of that property to the building. I think what was the number, about $2,200 a year ish. So, let's say, you're 5 years in, let's say you didn't take any depreciation on that building, right? But after 5 years, you would have been eligible to take about, what would that be? $10,000, $11,000 of depreciation, right?
Yeah.
That's what you could have taken in that 5-year span. And then let's say you sell that property after 5 years. So when the IRS views your gain, they're going to view you as your gain as though you had taken that depreciation over the years anyway. So you're going to be paying that recapture tax whether you actually take depreciation or not. So it's in your best interest to take the depreciation.
What are some categories of expenses that I might be eligible to deduct if I maintain good records?
Well, it's really any expense you have that's attributable to your rental real estate activity. So that could be, if you pay the utilities on the property, right? If you pay somebody to maintain the landscaping, pest control, any supplies you need to keep up the property. If you pay, obviously your property taxes, your mortgage interest if the property's leveraged. If you drive out to the property, you can take an auto expense, and there's a couple ways to calculate that. You can just use the flat, the flat rate mileage, or you can actually prorate your vehicle based on how many miles you drove during the year for your rental, and how many miles during the year you drove just that's not related to your rental. And you can depreciate your car, and you can take some other, so you basically prorate all the gas you paid during the year, your insurance on the car, and all that based on your rental use percentage. You got advertising, right? If you're paying somebody to advertise your rental for you, if you're using a real estate agent or something like that, or a property manager to lease out your property, so those management fees throughout the year. So really, just any expense that's related to operating your rental real estate business is fair game. Where you want to be careful is, and I think this is where some people tend to maybe stretch the truth a little bit, is let's say they have a few houses or something, and they have they use like their cell phone, right, to talk to their property manager or whatever. Just because you use your cell phone once in a while to talk to your property manager doesn't mean you can write off your whole cell phone bill.
Mm-hmm.
You gotta do this proration thing, kind of like with your car, right? So theoretically, you should be looking at how many minutes did you spend related to your real estate activities on your phone over total minutes you spent on your phone. Let's say that's 10%. So you could multiply your cell phone bill for the year by 10%, and that's what you could deduct. So there are lots of expenses you can take, but of course you want to be honest with them.
Let's just say I have properties out of state in the Midwest, and if I want to go check on my rentals, what can I deduct? Can I deduct my travel expense, my food, hotel, rental cars, things like that?
Yeah, so the IRS says if your trip is primarily for business reasons, and how they define that is more than 50% of the days that you spend on your trip are in fact business days. And a business day, kind of a rule of thumb, is a day in which you spent 4 hours or more on your business. Then you can deduct all your travel expenses during each business day. And travel days count as business days. So that's kind of a roundabout way to say, yes, you can, if the trip is primarily to visit your rental properties based on the majority of days, then yes, you can deduct your reasonable airfare and lodging and things like that. And weekends are considered rest days. So they could, if you're doing business on Friday and you're doing business on Monday, the weekends are considered rest days, and so you can deduct travel expenses on that weekend as well. But there's kind of a nit to that where it would have to have, in order to deduct those weekend expenses, it would have to have been less costly for you to stay the weekend at the location where your rentals are than to travel back home and come back on Monday. So long story short, yes, you can deduct your legitimate travel expenses. There are just some rules to be aware of, and hopefully your tax pro is aware of as well.
Okay. What are some bookkeeping mistakes that you might see with newer investors? And can you share with us any tips and tricks that they can use to keep good records in the case that they're audited?
Sure. So I think the number one thing is have a dedicated account for your rental business. It could be a bank account, a credit card, right? Or both. Because where things get messy is when people are paying for their rental expenses from their rental properties out of their personal account. So not only is if we're just isolating it from a bookkeeping perspective, that can get very messy and confusing. At the, let's say you're doing your books, monthly or yearly, you have so you're going to have this bank statement. There's all these personal expenses and business expenses in there. It can get really messy. So the easiest thing is to just have dedicated accounts that are only used for your rental properties. And then you want a system in place to categorize those expenses. I mean, QuickBooks Online is so inexpensive now. Some people like Xero, Xero2. You can link up your accounts, your bank account, your credit card account into software like that. All you have to do is categorize your transactions, and then QuickBooks or Xero, whatever platform you use, will produce for you at the end of the quarter, a year, or however often you want it, a very tidy set of usable books for your tax return. So if you know that all your expenses are running through this account or these two accounts, and they're all being captured in QuickBooks, and you're categorizing them periodically, you know that you've captured all of your expenses that you can conceivably deduct against your rental income. Now, in terms of bookkeeping, so bookkeeping mistake number one is not doing that, right? Just using your personal accounts, and things get all messy and confusing, right? So that's mistake number one. Mistake number two, I would say, some people get confused when they're booking the purchase of the property, because when you buy a property, you get this settlement statement, right?
Yeah. And
it has the gross sales price, and then it has like this line which ties back to another line, which is all like the lending costs, right? Your origination fee, the title fee, and all this title insurance, and all this other stuff. And then, then that you go back to the first page, and then there's all these like what you already paid, and then there's these other costs, so there's kind of a couple ways to go about it. One way is, hey, I don't have a business entity that files its own return. I don't really have to prepare a balance sheet, so I don't really have to, so I don't really have to book that stuff, right? And then, but you still want to give that document to your tax preparer at the end of the year, so that they can categorize things correctly for tax purposes. The other way to go about it is to actually book, the purchase of the property correctly in your bookkeeping software, which can be a little bit, tricky if you've never done it before, because you got to categorize all those items on your closing statement correctly. Now, is that absolutely positively necessary for you to report your rental income and expenses correctly on your tax return? No. Just as long as you have a good tax professional helping you with that. Because there's a lot of things on that closing statement that could be deductible to you. That's not necessarily running through your business bank account and credit card individually, every single item on that statement. But there are still some things that could be deductible. Some of the loan costs could be amortizable, which is something I think a lot of newbies miss. But so that's one mistake that I see people. If they're doing their tax return themselves or the books themselves, they can kind of screw up the recording the purchase of the property correctly from the closing statement.
Yeah, no, I think that was great advice. One thing I really didn't think about was the HUD and settlement statement, making sure that we categorize that correctly. Many buy and hold investors might use property managers because their properties are out of state. So if I have my property manager oversee a rehab, so for example, I give them the authority to go get some bids, do some paint, flooring, fixtures, and it costs about $4,000, and it's in a summary statement, do I necessarily need to request the receipt of each individual line item, or can I just take the property manager's statement or the bid to provide a support?
There's oftentimes with rehab, there's so many change orders and things like that. What I would do, well, for 4,000 product maybe, but I had a client once, and he was just rehabbing so many things, and he just left it up to the property manager, and the property manager gave him the report at the end of the year, And that's what he gave me, like, a few days before the deadline. And it was just, and there was the bid, right, which was a lot lower than what was the actual amount of the rehab, right? And so, the bid was kind of nicely mapped out. We're going to do this and this and this and this and this and this and this. But then, the actual cost and the property manager literally had an item. It was like a huge item for their year. It just said like rehab expense. And then their monthly statements weren't very helpful either. It was just like, I forget what the description was. So in that case, and as a tax preparer, seeing from a tax perspective, I got to know what the details of what went into that, right? And so I would want at least all the change orders along with the bid, and hopefully it ties out to the actual amount paid. Just so I know how to categorize those things correctly for tax purposes. Because when you do a big project like this, maybe some of that work that was done is 27 and a half years should be depreciated. Maybe some should be depreciated over 15, some over 7, some over 5, maybe some we can just expense now. So you really want something that ties to that final, whatever the cash outlay was. And I know property managers aren't always thinking necessarily from a tax and documentation perspective, but you want something that ties out to what was actually spent, because you don't want to assume anything.
Let's kind of segue into LLCs. I know this is a hot topic amongst real estate investors in the Bigger Pockets forums or various Facebook groups that I'm a part of. And I was wondering if you can help dispel any myths out there in terms of how an investor should use an LLC. Do they even need an LLC to take some advantage of these benefits?
Yeah. So, for a buy and hold investor, there's not really any tax benefit necessarily to just having that LLC. There might be some legal benefits to having a properly structured entities that through which you make your investments. But for a buy and hold investor from a tax perspective, there may not be a whole lot. There's not real. I mean, what I'm saying, you could take the same deductions with or without the LLC. You pay a plumber to fix the toilet, you can take that expense whether or not you have an LLC.
We've really covered a lot of ground in terms of the benefits of real estate investing, depreciation, and some of the uses of an LLC. So let's just say our passive losses exceed all of our income, so we're in the red. Can we carry that forward in perpetuity, or do they expire? Some investors are wondering if they can use it to offset their W-2 income. Can you share with our listeners any tips and tricks on that?
Well, there are some strategies. So, the rule is that the general rule is you can't take passive real estate losses against your ordinary income. One exception is if you're a real estate professional. That's pretty tough if you have a W-2 job, because there's a 750 hour threshold, right? Which I think lots of people are aware of. But then there's which saying that you have to spend at least 750 hours during the year in your real estate activity. But then in addition to that, amongst other things, but there's also another requirement that the majority of the time you spend in a trader business, or let's just say working, the majority of the time you spend during the year working has to be real estate related. So let's say you have a full-time job, right? Let's say you work a lot of overtime. So let's say you work, let's say 2,500 hours during the year or something like that in your in your full-time job. So that's saying you would have to work 2,501 hours in your real estate business in order to be considered a real estate professional. So it's pretty tough if you have a full-time job to be considered a real estate professional. So but another way that you can deduct some passive loss or some of these real estate losses against your ordinary income is if you make under a certain dollar amount. So if you make under $100,000 And this threshold is the same for both single filers and married filers filing jointly. If you make under $100,000, you can deduct up to $25,000 of your rental losses against your ordinary income. And that $25,000 amount is reduced by 50 cents for every dollar you make above $100,000. And by you, I mean either you individually, if you're single, or you and your spouse, if you're married filing jointly. So by the time you reach $150,000 of income, incrementally, 50 cents for every dollar you make above 100,000. So by the time you have $150,000 of income, that $25,000 potential deduction is wiped out. So if you make more than $150,000, you can't deduct any of these passive real estate losses against your ordinary income unless you're a real estate professional, or unless you sold a property during the year that had passive losses that had built up over the years attributable to that property. Once you sell that property, you can then release all those passive losses against your other passive income or against your ordinary income. Because something you brought up is these passive losses expire, and the answer is no. So let's say you have 2 rental properties, and let's say you make $200,000, right? So you aren't eligible for the $25,000 deduction. So let's say I have these 2 houses. House 1 in year 1 spins off a $5,000 loss. House 2 spins off a $10,000 loss. So in year 1 you have net $15,000 of rental losses, right? You can't deduct them against your ordinary income because you're over that $150,000 threshold. So these losses just carry forward to the next year. Let's say the next year these properties are cash flowing a lot better or whatever, and between the 2 of them, you have $10,000 income, right? So you have this $15,000 passive loss from the previous year, and year 2 you have this $10,000 income. You can basically wipe out that year 2 income of $10,000 with these carryover losses from the previous year, right? But you have 5,000 losses left over, right? So the 15,000 from year 1 minus the 10,000 year 2. So you have these 5,000 left over that you can now carry forward to year 3. And let's say in year 3 you sell both of these properties. At this point, or you can sell one of them, but let's say you sell both of them. At this point, that $5,000 loss, right, that carried forward from previous years, it'll first count against, any passive income in that year. But then it'll also, if there's an excess, then in this case, even if you make more than $150,000, you can count it against your ordinary income. Ordinary income for the year. So the rules get a bit tricky with the passive loss limitation rules, but there are some ways to release them. And sometimes you want to plan things strategically surrounding passive losses. One thing to keep in mind is if you're doing a 1031 exchange, we didn't really touch on this, but if you're doing a 1031 exchange, you can take cash out of the exchange. That's considered boot, and boot is generally taxable. But wait, what if you have a passive loss carried forward on that property? You might be able to eliminate some of that tax on the boot by, relieving some of these passive losses against that gain when you sell. So there's a lot of strategies around passive losses. But just know you don't lose it, right? There's some things, like for corporations, they're charitable contributions. If they have excess charitable contributions, they lose them after 5 years, right? But with passive losses, they get carried forward indefinitely until they're released.
Oh, wow. So are these carry forwards, are they siloed by property, meaning property A with 10,000 in losses from 3 years, property B with only 2,000? Are they all pulled up in your tax return, or are they all siloed off when you sell them?
Yeah. So, let's say you have a 10,000 from property A and 2,000 from property B. If you only sell property B, only the 2,000 that's attributable to that property gets released that year. So they are siloed like that.
Gotcha.
Yeah.
And do investors need to keep all of that record of the history? It seems like a lot of data in terms of carry forwards, or is that kept in the tax returns?
Yeah. So there's a form called 8582 in which you track, and hopefully your tax software and your tax professional, if you use one, will complete this form for you. And the second page of that form, there's this grid, right, where you list all the activities and you put the carry forward, the passive loss attributable to each one. So yes, it is tracked on the tax return, or it should be. But
Okay.
and tax software does a great job of tracking it. Whether it's a DIY TurboTax type of thing, and obviously professional tax softwares do a good job of it as well.
Okay. Which brings us to the big question: do it yourself or hire somebody, right? And I think a lot of investors who might be doing flipping on the side or like to be really hands-on in their business might look at this and say, hey, this kind of seems like something I can do. Let me read up on it. And they try to take a stab at preparing their own tax returns. I definitely don't want to take the risk of missing any expenses or any strategy that will allow me to maximize my tax benefit. What are your thoughts on the DIY people versus hiring a professional to do this?
To be honest, I would say that in years that you buy or sell property, you definitely want a professional in your corner. I'm talking about buy and hold right here. Because something I touched on earlier is, you get that closing statement and you might not know how to categorize things and getting your depreciable basis right, because that's something that a lot of, I would probably say that the majority of DIYers that have come to me, after that first year have screwed up depreciation in some way, shape, or form. So there's a lot of stuff that goes into it. When you're, when you buy property, obviously when you sell property, there's some nits on the back end too. So, if you're a newbie, if this is your first year, like buying property, then I would say it's definitely worth it to work with a professional to make sure those things are set up correctly. Now, after that first year, you kind of got to make a decision. And it kind of depends on your goals for the property, right? Because or your portfolio. If you're going to buy a few houses and you just plan to hold them for the next indefinitely, not a whole lot of tax planning there. As long as you're keeping good books and records for your rental properties, and you're not doing some major rehabs or anything, well, you could probably just input those numbers into the tax software and it'll be fine. But if, your strategy, in subsequent years, obviously if it involves the acquisition of further properties or, you're doing significant rehabs or upgrades on the properties, then you'd probably want to enlist a tax professional once again. But that's my opinion. I mean, some folks will say, you should always hire a tax professional. And, while I think that's true, if you're going to be, if you have an expanding portfolio, right? I don't know if that's necessarily the case for folks who are just, kind of just very passive, smaller scale buy and hold investors after that first year, where you definitely want a tax professional to help you get it all set up correctly. But if your portfolio is done after a year or two and it's just kind of status quo for there on out, might be able to DIY. So that's just my take.
Awesome. One of the big things that you're doing currently is you are owner of a personal finance blog, Money Done Right. Can you kind of talk to us a little bit about that and what's in the future for you for 2019 and beyond?
Money Done Right is a personal finance blog that with the mission to help people just live happier lives by interacting with their money in a better way than they are now. Because there's so much misinformation out there about personal finance. A lot of people trying to, sell stuff to kind of make a buck. And I think for most everyday average Americans, personal finance shouldn't be complicated. So I share tips on there, how to make extra money, random side hustle ideas, money saving tips, passive income opportunities, my takes on investing and things like that. We're planning to grow really big in 2019. So be sure to check us out at moneydoneright.com and give me a shout out.
Awesome. Well, I'll have all that and more information in our show notes. Well, that wraps up the end of our show. Thank you so much for tuning in. And if you thought that this episode was helpful, please do us a favor and leave us a review on iTunes. It'll help us reach more listeners and share the good word. Be sure to come back right here next week to learn more about real estate investing and creating that bigger cash flow. Thank you for listening to the Bigger Cash Flow podcast. Please remember that opinions of the guests are their own, and nothing on this show should be considered personal or professional advice. Please consult your tax, legal, or financial advisor for personal advice that fit your unique situation. See you next time.